After months of high gas prices, we thought we were finally getting a break. Well, friends, all that could be coming to an end. So get that big wheel out of your parents' attic because OPEC's oil production cut could make gas prices skyrocket. And this just won't be pain at the gas pump. It could potentially cause inflation on almost everything you're buying. What is OPEC? Many of us don't even know what OPEC means. And that's okay. OPEC is the Organization of the Petroleum Exporting Countries. OPEC is a cartel of 13 oil-producing nations that aim to manage the oil supply to set the price of oil on the world market. And this is to avoid fluctuations that might affect the economies of both producing and purchasing countries. The 13 OPEC members are Iran, Iraq, Kuwait, Saudi Arabia, Venezuela, Nigeria, Algeria, Angola, Congo, Gabon, Libya, Equatorial Guinea, and the United Arab Emirates. Yeah, I know, the list is pretty long. Now, OPEC decides when to increase or decrease oil production. The organization controls 78% of the world's oil exports. Because these OPEC countries produce such a large share of the world's oil supply, they can manipulate the price per barrel. They control the daily number of barrels they sell on the market. And when certain non-OPEC members join OPEC to make collective decisions over the world's oil business, it is referred to as OPEC+. On Wednesday, October 5th, OPEC announced that it would reduce oil production by 2 million barrels per day. And this is scheduled to start in the month of November 2022. This amount is around 2% of the current global oil supply daily, and it is the largest cut since the beginning of the pandemic in 2020. Now, this is alarming because although the US is the largest oil-producing country in the world, it uses more than what it produces. The US produces 18.8 million barrels daily, but uses 20.5 million barrels. What makes this worse is this decision by OPEC comes after gas prices spiked in the US this summer. We made some price stabilization efforts that brought some relief, and now that gas prices have tended downward in recent weeks, we get this news from OPEC. Now, the summer highs came about because of fears that much of Russia's oil production would be lost to the market over the war in Ukraine. As a result, the US government has repeatedly pressed OPEC to ramp up production to keep the fuel prices down to help ease inflation. Now, why did OPEC decide to cut oil production? They say the decision was based on the uncertainty surrounding the global economy and oil market outlooks. But let's be real, this is how they soften the blow of a global recession on their own countries at the expense of others. Saudi Arabia's energy minister described the group's role as the guardian of stable energy markets. Now, when Russia invaded Ukraine, oil prices rose, pushing West Texas Intermediate (WTI) prices above $115 a barrel by June. Markets show concern over the stability of oil supplies as OPEC Plus's second largest exporter was in a heated conflict with its neighbor, sparking tensions with the US and Europe. Now, even with the war raging and little indication of it ending anytime soon, oil prices still began to fall in late 2022. WTI fell to $100 a barrel by July. As fears of global recession called global demand for oil into question, OPEC Plus jumped into action, announcing it would cut production by 2 million barrels daily to stabilize the recent slump in prices. Now, what happens when OPEC reduces oil production? The prices of fuel will rise as the supply decreases, and prices are said to have already started to rise. Oil prices have recently increased by 4%. Experts believe that oil prices would likely cross $100 per barrel. Analysts at PVM Oil Associates and Goldman Sachs see Brent reaching triple digits over the next 3 months before climbing to $105 over a 6-month horizon. Also, a Swiss quote analyst pointed out that the oil production cut might backfire against OPEC. If investors fear it will drive inflation higher and compel central banks to increase interest rates to the extent that it would result in a recession, it might also impact the European countries currently facing an energy crisis. This winter, Europe may face more problems due to the decision to cut oil production. Keep in mind, the increase in oil prices will have a ripple effect on the economy. Rising oil prices means higher gas prices at the pump, higher shipping costs, and higher energy costs when creating goods, ultimately affecting the prices of nearly everything. Meanwhile, the news shows that the US government plans to ease sanctions on Venezuela to allow Chevron Corp to pump oil in the country. Now, the overall impact of rising oil prices can't be underestimated. Something like this could be what breaks the scale towards a recession, and many businesses functioning on small margins may be put out of business because of an increase in energy and transportation cost. The OPEC Plus move also showed that some oil importers have become particularly vulnerable to price shock amid recent global supply constraints. Sri Lanka is facing its worst economic crisis since its independence from Britain in 1948, with a currency crash, runaway inflation, and a severe shortage of dollars to pay for essential imports of food, fuel, and medicine. The president of Sri Lanka has warned that they will likely have to pay more for fuel as wealthier countries stockpile to meet their needs. This is not only a problem facing us, he said, but it is also facing several other South Asian countries. He told Parliament on Thursday, "Global inflation will hit us all next year." Okay, you might be wondering how the world has reacted to this news, but as expected, the global reaction is unpleasant, which isn't surprising. The world rightfully has fears of oil cuts as they threaten to push back countries still bearing the brunt of the pandemic and the negative impact of Putin's invasion of Ukraine. The reaction is a mix of anger and disappointment. U.S. Treasury Secretary Janet Yellen said the move by OPEC Plus to cut oil production was unhelpful and unwise for the global economy, particularly emerging markets already struggling with high energy prices. Now, the United States President Joe Biden is disappointed with the decision and has authorized the release of 10 million barrels of oil from the U.S. Strategic Petroleum Reserve as a short-term measure. The release of this oil in the market is a bid to increase supply for some time. However, the 10 million barrels will only buy the U.S. 5 to 6 days of stability. And since this decision, the Strategic Petroleum Reserve has been at its lowest since 1984. Back in March, President Biden ordered the release of 1 million barrels of oil per day for the next 6 months, excluding the 10 million barrels he had just requested. This move has sparked several responses. Some critics argue that oil prices will go up after the elections beginning on November 8, so they shouldn't use the reserves to try to win the election. Others say that reserves are for use during emergencies, just like this one. Stephen Brennick, a senior analyst at PVM Oil Associates in London, said in a research note, in its own words, OPEC's mission is to ensure an adequate pricing environment for both consumers and producers. Yet the decision to reduce output in the current environment runs contrary to this objective. Further squeezing already tight supplies will be a slap in the face for consumers. The selfishly motivated move is aimed purely at benefiting producers, he added. In short, OPEC Plus is prioritizing prices above stability at a time of great uncertainty in oil markets. A director of research at Global X EFT's Rohan Reddy said that volatility would likely return to the market due to the decision. And despite concerns about the global economy's resilience, the oil market is tight, which could result in higher prices in the fourth quarter. Okay. What is the proposed advantage of this oil cut? The intentions of the OPEC Plus cut was to break the fall in crude prices since the summer. Now, an energy analyst said if they succeed, gasoline pump prices should stop falling and would range around current levels until other market drivers impact the price. The oil cut is obviously helpful to investors and oil companies as their share prices get a boost in times of high oil prices. However, if prices rise, lower-cost manufacturers may enter the market, and this balancing act is currently occurring between OPEC countries and U.S. shale producers. When government restrictions are eased, the U.S. shale production can turn on the taps, increasing supply and driving down oil prices. Now, let's talk about the overall negative effects of the oil production cut. High oil prices will hurt corporate profit margins in most other industries. Oil is widely used for manufacturing and transportation services, and rising oil prices will greatly impact these types of businesses. If businesses have small profit margins and can't pass these higher prices to their consumers, their profits will disappear. When utility costs rise due to rising oil prices, most consumers will decide to cut unnecessary expenses. They will choose to spend less on luxuries to afford necessities. Now, HRIS has advised consumers that anyone shopping for an automobile or a vehicle today should be looking towards a more economical one in terms of mileage. Still talking about the setbacks caused by the oil production cut. Of course, the Russians are very interested in the supply cut. Even with sanctions, Russia still has buyers for their oil. So this gives them leverage in the price of the oil they can sell to India and China. And that's exactly why the Russian Deputy Prime Minister, who was just sanctioned last week by the United States, traveled to Vienna and helped forge this deal with the Saudis. Some view this move as a Russian bailout, helping Russia boost its oil revenues to help fund their invasion of Ukraine. And the US President Joe Biden has promised consequences. There's going to be some consequences for what they've done with Russia, Biden said. I'm not going to get into what I consider and what I have in mind, but there will be consequences. However, in an interview, Saudi Arabia's Minister of State for Foreign Affairs responded that they are not taking Russia's side. He said that they are just trying to ensure the stability of the oil markets, which will benefit both the consumers and the oil producers. He added that 22 countries decided to reduce the quotas unanimously, and the markets have responded positively. Now, the effect of the production costs on the U.S. economy shows that oil prices have multiple impacts, and this is due to the diversity of industries operating in the U.S. Rising oil prices could potentially help create jobs in the U.S. oil industry and encourage investment, enabling companies to develop high-cost shale oil projects. However, rising oil prices could affect consumers and businesses due to rising transportation and manufacturing costs. Falling oil prices would have the opposite effect, limiting unconventional oil activity but benefiting other sectors sensitive to fuel costs. Now, while the production is said to be 2 million barrels per day below the current quotas, supposedly OPEC Plus is already producing 3.6 million barrels below their quotas. The International Energy Agency pointed to factors contributing to the economic recession in its monthly report, including inflation and central bank interest rates. And the agency stated that with unrelenting inflationary pressure and interest rate hikes taking their toll, higher oil prices might prove to be the tipping point for the global economy on a brink of recession. Today, OPEC Plus uses their dominant market position to wield powerful influence over world oil prices. However, differences in the long-term goals of member states and increasing production from countries outside the group could limit OPEC Plus's ability to control prices over the long term. Let me know down in the comments what you guys think rising oil prices will do to our economy, and remember to like and subscribe, and you guys have a great day.